special journals and subsidiary ledgers. So what's the objective of this particular exercise, and then I'll give you some instructions of the best way to make the most of it. So I'll go through an update of the basic terminology. Let me give you one bit of guidance beforehand. If possible, can you watch this on full screen? If you watch it on full screen, things will fit much better for you. So update on basic terminology in case there's just a few things that you're not totally sure about. And then the rest of it will really be talking about special journals and their relationship to subsidiary ledgers, and about how you post from special journals to the general ledger and the subsidiary ledger. However, we will start off in this case by a review of how we've done things up to now using the general journal as opposed to the special journals. And that will also help you appreciate the advantage of the special journals, especially compared to the general journal. We'll also talk a little bit about the terms of trade. You'll need to know that when we get to discounts. So if terms of trade say 210 net 30, well, the key bit there is the 210 means if you pay within 10 days you would get a 2% discount. So instructions for this. And first a bit of guideline, maybe have a look at the assignment beforehand, especially regarding the transactions and posting the transactions, and look for the similarities between the assignment and what is here. This should be a significant benefit for your assignment. Depending on which you're coming at this first, whether you're coming with the video or with the spreadsheet. So I've got a note in there that should be accompanied by a video, and the link's going to be the topic note. So you've got that already. Print out the transaction pages, and I've put terminology on the bottom because it all fits on one page. So I'm suggesting you print out the transaction pages, the transaction page. So we've got 13 transactions, and there is also terminology which will come on the bottom of that. Then there's a sheet a bit later which is called a summary, which you just might like to print that one out as well. Then enter the transactions into this file. Now, steps 5 and 6, they're written in red. They're written in red because I want to draw your attention to them. So, I want to draw your attention to them because this is not the way you're going to do it in the assignment. This is the way we've done things up to now. I don't want to do this so you have a sense of the advantage of special journals over the general journal. And it's also great practice. So what do? We enter all the transactions involving a credit sale into the general journal. And so I'm just going to pick on credit sales, not do every single transaction. And also post the journals to the general ledger. And I've got that note. This is just for practice and help you discover why we use special journals. Do not do it this way in your assignment. Then we're going to do it the right way. So, well, Then 7. For each transaction you need to determine which special journal is used. And the summary page that you printed out, or you didn't print out, at 3.1 might be helpful in this. So we'll come back to that. Let's get started. Let's have a quick review of terminology. Then we'll move into the posting the transactions. Terminology. I won't go through all of this now because it's something you can read. But just to point out some things that people sometimes have some issues with. I look at credit note. A credit note is a bit like the reverse of an invoice. Let me explain how a credit note arises. And this you could be on either side of this transaction, but I'll look at it from you being the seller. So you sell an item to me for $100, a number of items to me for $100, and you sell them on credit. I decided 20 of those items were not what I ordered, so $20 worth, so I return those items to you. And you say, yep, that's right, that wasn't what you ordered. So you issue me with a credit note to say, here Brent, you don't owe us that $20 for those items, and that's the credit note. and then you'll go through and record that in the journals. A note payable, I also talk about a note payable. A note payable is much like a account payable and a note receivable, which is the other side of the note payable. If you have a note payable in one person's books, there's a note receivable in someone else's books. And the note receivable is just like an account receivable, but it has a bit more security. And it has a few other advantages. So a note receivable, so again, you sell some items to me, and you could just sell them on an account. And on the account, just the way you've gone through your normal processes. But then say comes time to pay, and I say, look, I don't have that money at the moment, but I'm going to issue you with a bill of exchange. And that could be the note receivable to you and a note payable to me. And it is, you might think about it as an IOU, and you get it and it says, look, I will pay you this amount of money in this time, let's say 30 days. Now, why would you do that? Why would you accept that? Well, account to the account, compared to the account receivable, you have extra security. You've got that note. That note is probably negotiable. You can sell it on to someone else, and you also have the ability to charge interest. So they're the differences from an account receivable or an account payable. But we look at them later in the unit. And also I'll talk about perpetual inventory. Perpetual inventory is when we record the cost of the goods sold at the same time as we record the sale. And we're using a perpetual inventory system here. That compares to something we'll look at a bit later called the periodic inventory system, when we only recognise the cost of goods sold when we do a stock take, typically at the end of a period. There's your transactions, and let's go now and post those transactions. So we go to the general journal. Actually, I've put them in here. Let me take them out. If I don't feel like taking them out, I might have to put them in again. Maybe I could have just shown you where they were. Now, some of you will watch a few of these, and then you'll decide to skip forward, because it is a bit repetitive. Righto. The record items in the general journal. And my suggestion to you is, in fact, you stop the video here and you go and do these exercises and then come back and see how you're going, because as I said, it'll be great practice. The first item happens on the 1st, and let's call it, well, I could say January the 1st. So let's go January 1. And what is that transaction? It's sell inventory on credit to client 1. So you're making a sale. So we've got to look in this transaction, what's the debit? Well, is there an increase in an asset? Well, yes, there is an increase in an asset because we're making a sale on credit. Therefore, an account receivable will happen. So accounts receivable will increase by $40,000, so it's a debit of $40,000 to accounts receivable. The credit, well, an increase in revenue is a credit, so we have revenue or sales, and that's $40,000. Let's call this item G1, and we record here credit sale to client 1. I've left the posting reference column blank for the moment, and that's reference there, and it's posting reference. On the same date, something else needs to happen. We have made a sale, but we've sold stuff. What have we sold? We've sold our inventory. So what do we need to do? We need to recognise that as well, that our inventory has fallen by an amount. So if our inventory has fallen, a fall in an asset is a credit. Inventory will be the credit. And what's the increase? An increase in the expense is the cost of goods sold. And I'll summarise that as COGS. Now the question is, how much? And let me go to another page. Looks like something I've prepared earlier. So we know this. Let me delete this again. Our sales, let's assume our sales are $100. We are told that the gross profit is 20%. You'll see that up towards the top of the transaction page. Gross profit, 20%. That's $20 or 20%. And what's the difference? The difference is our cost of goods sold. So if we made sales of $100 and we made $20 profit, then the cost of those goods sold were $80 or 80%. Now we've got $40,000 in here. So our sales, $40,000, 20% of that is $8,000. So 40,000 times 0.2 or 40,000 times 20%, and so that means our cost of goods sold is 32,000. So how do we get that? We take the 8,000 from the 40,000, which gives us 32,000. So the key figure we're after here was cost of goods sold. So let's go back to the general journal. We know our cost of goods sold is 32,000, and the reduction in inventory will be 32,000. Now I do have one problem here that I've just realised, is that I do not have an opening inventory. What will I do about that? Well, let me go to the general ledger, and let's say we did have an opening balance of inventory. 1 January opening balance, and we'll say we had $200,000 of inventory. Oops, so put that in the debit. That should be just in the balance column. $200 debit. $200,000 debit. So that was the opening balance. That means I should also have somewhere, which I'll just put in down the bottom, and it should go in there, but would be a capital account, or could even be a loan account. We'll say capital account, and that would be 1 January opening balance of $200,000 in credit. Oh, I just did that for completeness. Now, what is this? This is the inventory associated with, let's call it reduction, being reduction in inventory for sale to client 1. And we'll call this G2. Now let me do another one on January 2. We've got exactly the same account receivable, and the account receivable is $10,000. So what have we got? On January 2 we've got a sale of inventory for $10,000, sale of inventory on credit, so therefore we have an account receivable, which is the debit, and a credit for revenue, $10,000. And this is being credit sale to client 2. Call this G3. Now, because we have made this sale, we also need to recognise at the same time that we've had a reduction in our inventory. So again, we'll have a credit to the inventory, and we'll have a debit to the cost of goods sold. What's the amount of this? We know that our cost of goods sold is 80% of our sales revenue. So 80% of 10,000 is 8,000. 40,000, and this will be item G4, and this will be being reduction in inventory for sale to client 2. Now I can go on and keep putting these in. I've done 2 out of the 5. Actually, there's probably not enough space there, so I might add some things to the bottom of that. And that might be good practice for you to go on and do that. I will put the solutions in there somewhere. I'll post those up if you want them, but you may not need them because I want to do the next step now. And what's the next step? We need to post these items to the general ledger. So how do we go here? January 1, accounts receivable and revenue 40,000. So we've got 1 January, reference, I'll leave that $40,000 debit, balance is $40,000 as a debit, explanation is sale to client 1, the reference, that we got that from journal G1, general journal 1. Now the other side of that transaction is sales. 1 January, sale to client 1, credit, should have said credit sale to client 1, credit sale to client 1, reference G1, that is a credit, 40,000. The balance is credit 40,000. Then the next part of that journey is a debit cost of goods sold. 1 January. So sale to client 1, reference is G2, it's a $32,000 debit, and our balance is 32,000 debit. The other side of that is our inventory is going to fall. 1 January is sale to client 1, reference is G2, and it's $32,000 debit. So, whoops, it's a $32,000 credit because it's a reduction. So that means this will come 168,000. So we've got the opening balance, which was a debit, less the credit, gives us 168,000. And that's G2 as a reference. We've got that. Alright, let's go back and post the next journal entry. Well, there's one further step. We now need to indicate in the posting reference column that we have in fact posted these items. So account receivable was account 101, I think. Revenue was 501. COGS was 105. No, COGS would have been, hold on, can't be right, check. This should be 401, inventory should be a 400 account. Cost of goods sold should be a 500 account, 501. Inventory 105. So what do these numbers mean? Well, I've written 101 in there to indicate that I've posted that item to account 101. In inventory I wrote in 105 to indicate that I'd posted it to account 105. Alright, let's do the next entry. So account receivable revenue of $10,000 to client 2. So 2nd of January, sale to client 2. 2, this will be G3, and it's $10,000. It will be $10,000. It will be 50,000, sorry, which is 40,000 plus 10. Now we need to go down to the other part of that, and we see sales to January, and that will be credit sale to client 2. This is G3. It is $10,000. So that becomes 50,000 credit. Now we need to recognise the cost of goods sold. So 2nd of January, and that's the sale to client 2. This will be G4 journal. The amount of the debit is going to be 8,000. Well, it was 8,000. So we go balance now 40,000. Cost of goods sold so far. And that's a debit balance. Where did this 8,000 come from? Let me just go back here and show you. It is that 8,000 in here. So cost of goods sold is 8,000 from there, and the inventory that we'll see up the top is 8,000 there. So now we'll go to the inventory credit. 2nd of January, and that is sale to client 2, journal G4, $8,000, and so the balance comes down to 60,000, and the balance is still a debit. Now we need to go back and indicate that we've posted these items. So accounts receivable, we posted that to 101, revenue we posted to 401, cost of goods sold we posted to 501, and inventory we posted to 105. I'll save that. Now we would keep going on doing the same thing. And so if we go to the general journal, for A, we'd find we have a really long general journal. And when we get to the general ledger, we would have a lot of transaction in these accounts. Like we've only done 2 here. Imagine if you had 20 transactions, how full that will be. Well, then imagine if you had 50 transactions, how that would be. Or if you had 1,000 transactions, how full that will be. We've got a little bit there with just 2. If you go through and do the 5, as some of you will, you'll start to see that's a little bit long. So what does that lead us on to? It leads us on to a far more effective process for doing this, and that is going to be by using special journals. Now I will look at that. I think I'll go to another video to look at that. We've been 23 minutes already, and so we'll go straight into the special journals. Let me point out one other thing that you would need to do here. These credit sales, we would also need to post these to the subsidiary ledgers. So what happens here? We have a credit sale to client 1, 40,000. So we go to accounts receivable, it is client 1 January, we go to Jan 1, explanation, credit sale, debit 40,000, balance 40,000. This was G1, and the balance is 40,000 debit. Then we go to the next item. Now to indicate that we've posted that, we would come back here. We would come back here, 101, account receivable, and we'd put in a tick. You see we don't have ticks any. Well, seeing T's are easier than ticks, we put in a T. So 101 means we've posted it to the control account of accounts receivable, 101, and we've posted it, the T, to the subsidiary ledger. Now let's do the next one. Client 2 credit sale is $10,000. Subsidiary ledger, January 2, credit sale, reference G3, debit $10,000, $10,000 is the balance in debit. Now, one other thing we would notice here, and this is where the concept of control account comes in, these are subsidiary ledgers, and the total of the subsidiary ledgers is $40,000 here, $10,000 here, so the total is $50,000. So we now need to go to the general ledger and look at accounts receivable to see if it is $50,000. So accounts receivable, general ledger, what's the total value of it? $50,000. And here is the concept of a control account. The general ledger is the control account to the accounts receivable. The general ledger account of accounts receivable is the control account to the subsidiary ledgers of accounts receivable. So we can see where these things are probably correct. Well, they're not incorrect. So what has that told us? The balance as per the general ledger is $50,000, and that agrees with the total of the individual accounts. Righto, that's 26.5 minutes. Let's call that a stop, and we'll come back and look at the next part.